This meeting is being recorded.
Good afternoon. So today I'm going to give you a basic concept about working capital management. There are a lot of things to know about working capital, but the thing is, here we are going to discuss a little bit of basic ideas. So I'm sharing you the slides. There are various aspects you will come across during the course of the lecture. So this is basically part one of my lecture, and working capital management basically. First, let me start with the concept. Concept. So, what is working capital basically? Working capital is that part of capital which is used for day-to-day activities of any organization. Now, before that, let me tell you the division of capital. Working capital is a day-to-day part, day-to-day activities capital, whereas there is another type of capital which is basically known as long-term capital. Working capital is a short-term one. Okay. Now, from the definition, it is clear that is day to day for day to day activities. So, from today's discussion, part by part, what you will actually learn? You will learn about various concepts related to working capital. What are the components? What is working capital cycle and how working capital can be optimized? Basically, working capital is a finance and accounts specialization topic. As you can see from the slide. Now, working capital, as I told already, it is a short-term capital and short-term investment decision by any firm or any business. And as I told that long-term investment decisions are there, which is another major area of finance that is known as capital budgeting, about which we'll learn later on. So, working capital and capital budgeting, these two actually control the entire investment decision in any business or organization, any company. Now, working capital deals with current assets and current liabilities. So, in my earlier presentations, I discussed about the corporate balance sheet in details, where I discussed about current assets and current liabilities in total. So let me recapitulate a little bit. Now, by definition, we can say that current asset are those assets which are converted into liquid cash within a period of 1 year. We know that it is a short term asset, and current liabilities are those liabilities which are liable to be matured within a period of 1 year. Here, this particular term is very important, within a period of 1 year. It indicates that both are short term in nature, and already we know that working capital is a short term investment decision, so it deals with the current assets and current liabilities, whereas the long term investment decision, it deals with long term assets and long-term liabilities, which are also known as fixed liabilities and fixed assets. Now, working capital, why it is so important? Working capital is basically known as the lifeblood of any company. Now, why it is termed like this, lifeblood? We all know that the blood circulation, how much it is important for our daily living, blood circulation in the body. And if the blood circulation is stopped, so anyone can die within minutes. So working capital management is so sensitive factor for any organization that any little bit slightest possible mismanagement in working capital may finish the business or may finish the company within a very short period of time. So, working capital management is extremely important from this aspect, and it is also important to ensure the smooth operation and to maintain the liquidity of any company or any business. So, working capital can be divided into two types. One is gross working capital, which means the sum total of all the current assets, and net working capital. Generally, this is known as working capital, basically, the net working capital, that is equal to current assets minus current liabilities. And obviously, when it is current assets minus current liabilities, that means the current asset part should be greater than the current liabilities to get the positive net working capital. And it involves the short term financing decision, as we have already discussed. Now, what are the components of working capital? Now, before coming to the components, let me tell you something about some prominent example of that is current assets and current liabilities. Current assets mainly comprises with inventory, which has got three different types. There is raw material inventory, work in progress inventory, and finished goods inventory. And after that, debtors, that is sundry debtors, which is also known as accounts receivable. Now, what are debtors? We all know, because to whom a company will get something from whom in future, they are the debtors. Now, from whom means basically they are the buyers. So if the company go for credit sales, then they offer the buyers a certain time limit to pay. Buyers need not pay anything at the point of time of buying, So as long as buyers are not paying, may it be for 15 days, may it be for 1 month, may it be for 2 months, may it be for 3 months even. So as long as buyers are not paying to the seller or to the company or business, those amount is noted in the balance sheet under current asset as accounts receivable. Now, why it is short term? Because if any business cannot recover its fund from the buyers within a period of 1 year, that means the business is finished. So, as I told, that it may be 15 days, 1 month, 2 months, 3 months, or for the big companies, basically, it may be few more months. But generally, ideally, accounts receivable tenure, it doesn't cross 1 year. But in few very exceptional cases, we have seen that it may be up to 1.5 years for a very, very big deal. But that all depends on the conditions and the what I can say, the agreement between the buyers and sellers. But ideally, accounts receivable tenure is always less than 1 year. Similarly, say for the inventory. Inventories means stock. So stock of raw material, if it is kept in the godown warehouse for a long period of time, that means the company's production cycle is very long. Company cannot afford to keep raw materials months after months. Raw materials will come, enter into the godown. At the time of production, they will be taken out. They will be used for production. That will be converted into finished goods. And that is basically activities related to very short term period. Now, after raw material, there is another type of inventory, that is work in progress inventory. It is the shortest, it is the inventory of shortest duration, because work in progress means, say, one type of product is produced from the raw material, but that product will be used as further raw material to ultimately produce the finished goods. So during this intermediary phase, that is when from the basic raw material, that converted second step raw material was produced, that means they are in process. They are not converted into finished goods. They are in process. So that is known as work in process or work in progress inventory. And there are finished goods inventory, means when the process inventories ultimately are converted into finished goods. So they are kept in the warehouse and they are ready to be sold in the market. So obviously, you can understand that raw material conversion to WIP conversion to finished goods. These things, if are not fast, then it is a sign of stagnancy in the business. I'll come to that later on, come to that part. But generally, inventory holding period in any form, that should be as short as possible. 1 year is a very big time, basically, for this. So automatically they are coming under current asset. So accounts receivables are also, I've discussed. Now, the third most important current assets are coming cash and cash equivalents. Now, there are in between, there are a few more types of current assets like, say, your short term securities invested in the market, then income due but not received, which is known as accrued income. Then, say, cash equivalents means the instruments which are very easily convertible into cash. As I told, short term market securities. Now, cash is the third most important part of current asset. Cash is usually considered in two parts. One is cash in hand, another one is cash at bank. So basically, these are major components of current assets. And current liability, the first major component of current liability is sundry creditors. So, as I told, sundry debtors, similarly, when the company or business is buying something from the suppliers and not paying immediately, they will remain as the creditor to the supplier in their own books of accounts. Means the suppliers will remain as the creditor whom they will have to pay. That is the liability. As long as they are not paying, it is remaining as the liability. So they will have to pay to the creditors, and it is very obvious that creditors are not very much eager to make the duration long for receiving payment from the company, those who are buying from them. So company will have to pay them as early as possible. 1 year is a very long time for them for payment. Why? Because as fast as possible they will pay, it will increase their credibility in the eyes of the suppliers. Suppliers will be readily eager to supply more and more goods to them without any objection, without any problem. So it will be a smooth affair. Next, accounts payable. Now, sundry creditors, there also the payment is linked. But apart from that, there are some other items which company has to pay within a period of 1 year. So accounts payable, like say, for example, outstanding expenses. Like a company has taken an office floor on rent. Usually we know that in the month of March, 31st March, the accounts are closed. So company for the last 2 months of that last quarter, they couldn't pay the rent. So that will remain in company's book as accounts payable because that is remaining as the liability as long as company is not paying. But company cannot keep that liability for fairly long time. Say for the last 2 months, February and March, in the fourth quarter, they couldn't pay. So they will have to pay it within, say, April or May or June for the next financial year to clear their liability. So that is known as accounts payable. Now, under this, some bills payable, it is there, like accounts receivable, there are bills receivables are there. So I'm not going into that depth right now. Apart from this, there are certain provisions which company has to meet up, like provision for taxation, provision for employee welfare, provisions for, say, depreciation. This thing, all these things, company usually keep as provisions, but those provisions will have to be converted into actual expenditure or actual payment or actual utility before completion of the final audit, which we know that within 6 months of the closure of financial year, the audit has to be finished. So automatically, they're all coming under current liabilities. Okay, so these are basically the components of current assets and current liabilities, and as well, they are the major components of working capital. But out of all these, what I told in the slide, what you are finding, that is inventory, accounts receivable, cash and cash equivalent, and accounts payable, they are the major components of working capital for any company. Okay, so this is the first part of this lecture, and we'll continue with working capital gradually in part 2, part 3, part 4, like this. So, for the time being, it is the time to understand and read for you from any financial management book. So there are a lot of books like I. M. Pandey, Khannan Jain. They are the major textbooks. So you can go through what I am telling. You will find all these things in the book. And subsequently, we'll proceed further. Till then, goodbye for part 1. Thank you.